How we doing, everybody? Trying to suffer the weather. There's snow on the ground right now. Will not do this. I wore my special shirt for today, so this is actually a gift from one of the Mac holiday parties that one of the students got me. I wear it every time we talk about Enron. I actually put a spare shirt in my car because I think it's going to be a little bit too warm to wear this afternoon. But I couldn't resist. Every time we talk about Enron, I'm going to wear this. I'm used to wearing it much earlier in the semester because we talked about Enron at the beginning of the semester and past semesters. But I felt this is an appropriate time to talk about our good friend Enron, which we referred to many, many times in other courses. How many people have studied Enron in depth outside of this course? I mean, so, okay, Jared, so you know a little bit about this. So there's some interesting stories about Enron that we could tell. First of all, I think that the YouTube video that I had you all watch did a pretty nice job of summarizing Enron, the smartest guys in the room. That Cold Fusion channel, they take existing information about the topic, and they do a really nice job of summarization. In forensics, we did Theranos, which was basically just bad blood. Really summary about bad blood. This one was smartest guys in the room. By the way, if you're looking for anything to watch, that's documentary that kind of expand your knowledge, I definitely recommend that video. It's a good one. It has some adult content in it, which leads to a funny story. Again, I think I've told the story before, but just for reiteration purposes. My first year teaching auditing, I watched Enron, the smartest guys in the room with my class. So does everybody remember in the 20-minute YouTube video they were watching, they talked about Lao Pai or Lu Pai, depending on who's new. And it says he was fueled by two things, cash and strippers. And they had like a really brief cutaway of an exotic dancing bar, but you didn't really see anything. It was just kind of thrown off. In the smartest guys in the room, there's like a 30-second clip of women dancing. And it's just the most obnoxious thing. It's like the documentary maker said, I'm going to spice this up a little bit. This is really, really boring, you know? So I had never watched the video when I first saw it, and I showed it to my students in the class, and they just a lot of giggling going on. I was like, yeah, I'm sorry about that. I had no idea. I thought this was going to be a boring accounting documentary, but what's it without, you know, how do you spice anything up, I guess. Yeah. Anyway. I alluded to something with some of the groups, one of the groups that was talking in the class. I said that Enron had a very direct effect on my path. If it hadn't been for Enron, then you may be listening to really bad jokes and memes from some other auditing professor talking to you. A little bit of story time. I think I've told some of this already. I actually graduated in the semester that Enron collapsed. That was spring 2002. And it was very interesting because I was taking auditing during my final semester. And my auditing professor, I had mixed feelings about him. He's a wonderful human being, and he was a very good mentor for me. But as part of the way he taught auditing, it was a lot different than the way I teach auditing. So he was very memorization based. It was like, I'm going to give you notes, memorize all these notes. And I thought, well, surely you can't be serious. And then I took the first exam and I got like a 58. And it was just like, okay, I got to memorize. I got an A on the second exam for that note, but this was a class that was very heavily focused on exams. There were exactly two of them. You bombed one exam, that was it. You were kind of out for the class. So that was a problem in that. So Enron was going on, and does everybody remember my discussion about professional interactions that I've had in classes? And I tell you, I was really bad at professional interactions. I don't think you all realize just how bad I was at professional interactions. The professors at OU did not take any stake in that. They were there for teaching and research, mostly research. And they were great, but they didn't have any stake in it. So you all should thank your lucky stars. You got somebody like Dr. Caden who's just like, you got to network, you got to develop those professional opportunities. And she'll reach out to the stakeholders and try to say, we got a great candidate that's looking for a position. Because that doesn't exist at other universities. I'm living proof of that. So I thought I was just going to graduate and move down to Dallas and get a job. Well, I did graduate, so I got 1 out of 3. All right. I did not find a job either in Dallas or when I moved back home to live with my family back in Oklahoma. It was actually an interesting story. I applied for accounting clerk position, which this is a position that's intended for people who have not got an advanced any kind of degree in accounting. This is kind of like an accounts payable clerk, an accounts receivable clerk, very, very basic bookkeeping. I did not get that job because I was up against 2 people with graduate degrees and another big pool of people with undergraduate degrees. It was just there was no jobs in accounting in 2002, and so that was the worst time to try to get a degree in accounting. So what did I do? I went to work for a donut shop for a few months, and then I took 6 months off, sat for the CPA exam. Still could not find a job in accounting, so I went to get my graduate degree. And then my graduate degree, I was like, wow, accounting's kind of cool. I kind of like this. I could see myself doing a lot more of this. Got very lucky, got a job with KPMG, and then I kind of all rolled forward from there. So if I had gotten my job in, if Enron had not happened, I'd probably get my job in Dallas, probably doing something I hate, and just kind of like, okay, well, accounting's not for me. I would have gotten a degree somewhere else. But it turns out, it worked out really, really well. So you can thank Enron for having me. Now, if you don't like having me, then you can blame Enron for having me. All right, it works both ways. Yeah. Anyway, enough about me. Let's talk a little bit about Enron. So it talks about the biggest fraud in history. Now, financially speaking, this is not the biggest fraud in history. I think arguably you'd probably say WorldCom is the biggest fraud. We're going to talk about Lehman Brothers next week. Like Lehman Brothers is definitely the biggest bankruptcy, but there's some questions as to whether or not we can call it a fraud. And that's going to be why it's not going to call it the biggest fraud in history. That being said, I think WorldCom was one of those things that it was so people were so exhausted by the time that WorldCom happened. They didn't really, there was no surprise. Like Enron was kind of the first of the dominoes that fell. And by the time that all the WorldCom happened, there were a whole bunch of other dominoes that fell. We're going to talk about probably Tyco in forensics. That's one of the cases I had planned. That was another big case that occurred right around that time. I don't think anybody selected Health South for the presentations, but that was another organization that fell apart, and that's why I didn't select that one, because I thought that may be a case that people select. But a lot of companies right around this time said, yeah, we've got bad accounting practices and we can't maintain them. Yeah, we committed fraud. Yeah. And it was just kind of like, oh, well, another fraudster. It was just kind of ridiculous what was going on right around this time period. But it all started with Enron, which is why Enron's the one that's being appointed to. It's their fault. It's their fault. They were definitely doing stuff that was under the table and shady. And there was a lot of things that were talked about in this case that I think that we can get into. So before we talk about Enron, let's talk about Andersen. Now, there are a lot of jokes about Andersen. You know, it used to be the big five. Actually, if you go back far enough, I remember when my mother worked for KPMG for about 30 years. And I remember her talking about the big 12 accounting firms. So there were like 12 accounting firms that were kind of the national firms. And they talked about the big eight, and then they went down to the big six and the big five, and now we're at the big four. And we can't really get it any smaller because we have to have these size firms in order to be able to do these large clients. But it used to be much more disaggregated. The revenues of these firms was much smaller, and there were a lot more national firms. But they've kind of since combined, or in the case of Andersen, disappeared. Interesting thing about Andersen is Andersen was basically Deloitte back in 2000. They were by far the biggest and the most powerful of these, and they had their best reputation. But because of that, all that wealth, then there were a lot of incentives that went along with that. Now, we'll talk a little bit about the nature of Andersen and what happened with them. And you've heard me make comments about Andersen. The partner that I worked with when I started at KPMG in 2005, the former Andersen partner. He was hired by KPMG, says we really want to reboot our forensics practice, which again, fortunate timing for me. But Andersen was kind of thrown out of the bus, the entire firm, for this particular series of fiascos that occurred in 2000. But what about Andersen, Arthur Andersen himself? Okay. By the way, if you hear me say Andersen, that was technically the name of the firm. I think they had a longer term. That was kind of the term that was used. They just called it Andersen. Arthur Andersen is kind of the vernacular used to refer to the owner or the founder. And so if you did a little bit of searching for Arthur Andersen, how did they depict Andersen in this particular situation? And let's see, who's our first candidate to discuss this? I didn't write this down. My apologies. Oh, Mary, what did your group find out about Arthur Andersen?
Surprisingly, we found that many of the sources depicted him as a positive leader. For example, one of the first sources that came up was the Harvard Business School, and it placed Andersen as one of the great American business leaders of the 20th century.
Yeah. So Arthur Andersen has got a great reputation. He was considered to be one of the fathers of modern accounting. And so a few little stories about him. So there's actually a page on this page I found called Grokpedia, which I'd never heard of before, but it's kind of a Wikipedia site that's a little bit less detailed. But I had one on Arthur E. Andersen, and he had a statement that was made by Andersen. And I think this is a very profound statement. It's think straight, talk straight. So you basically tell people what you're thinking, and you don't try to provide any illusion or details behind it. You just tell them exactly what's up. He was very, very honest to a fault. Now, I'm not when I talk about honesty. This can actually be a double-edged sword. We can talk about honesty being one of those things that can impede business. But Anderson said he had no nonsense, no frills. He was just like, I'm going to tell you what I think, and if you don't like it, then you can make your choice and go somewhere else. And he suffered from that. Okay, he suffered from that. It eventually ended up paying off because they became the largest accounting firm in the world. But he started at Anderson. I think it was in the 1910s. I want to say not around 1915 it started, but it actually maybe a little bit earlier than that. Because in 1915 he ran into an issue. Now I want to set the stage for accounting around this time period. We're all very, very familiar with generally accepted accounting principles and standardized accounting practices. It was kind of the Wild West of accounting back in the early 20th century, early 1900s. Firms were doing reporting, but they were doing it on all kinds of different bases. So how you actually reported something was going to change from firm to firm. And that was a real problem because it affected comparability between firms. Like, okay, we had net income of $1 million. Well, we had net income of $5 million. That meant nothing because how they calculated net income could be completely different from each firm. And it wasn't until, I don't remember what the name of the organization was, but it was the predecessor to the Financial Standards Accounting Board. Financial Accounting Standards Board. It was, I don't remember what their name was, but I want to say the Accounting Principles Board, APB. But they kind of set up the rules and said, here are the guidelines you have to follow. And they basically made the modern accounting system that we operate with today, which I've got my problems with accrual-based accounting, but we'll ignore that for the time being. Accrual-based accounting is the source of much fraud. All right. So as we're going to find out here in a second. But he was kind of an advocate for saying, look, our responsibility is to provide transparency for stakeholders. This is Anderson I'm talking about. Anderson's responsibility is to provide transparency for stakeholders. And so he actually said, if it's something that kind of meets a certain principle, then this is what we're going to follow. We're going to follow the spirit of the law rather than the letter of the law, which is going to be very, very relevant next week because we're going to talk about this concept of substance of reform, which I'm sure you've heard that topic before, but it's a really important one, a prominent one in modern accounting. So in 1915, there was a steamship operator, and they had a sunk vessel that occurred during the financial statement audit. So we all know how subsequent events operate nowadays. If there's a subsequent event, you're required to report it if it has a material impact on your financial statements. All right, and this would be an example of a type 2 event, which would be disclosure or a pro forma financial statement. But those rules did not exist in 1915. And so the substitute steamboat operator says, if we report this to our stakeholders, then we're going to get really, really hurt in the markets. And there's going to be a lot of investors who are going to be very, very angry. And Anderson said, I don't care. This has to go on the balance sheet because this is something that's relevant to stakeholder decisions. There were not a lot of people who had the moxie to have that kind of stand at that time period. So he was kind of a trendsetter in that. 20 years later, this was a really, really big one. That was a small operator, relatively speaking, because Anderson was still a small firm. 20 years later, Anderson's one of the largest firms in the country. And they had a big client, which you probably have heard of this client, DuPont Chemicals. Okay. So DuPont Chemicals was doing some operating income definition. They had a very, very liberal definition. And I mean that they basically were trying to consider things that we would not traditionally consider to be part of operating income as that, which makes sense because a lot of people look at the income statement and they see what is the operating income line. That is what we're going to anchor on. That is where we're going to make our decisions. So the higher you inflate that number, the better off you are. Anderson said, or actually the audit engagement team says, we don't think this definition of operating income is appropriate. And so they argued with management team of DuPont for a very long period of time. And then DuPont said, let's call in Arthur Anderson and have him make a decision. And he said, I stand by my audit team. And they fired Anderson. They fired Arthur Anderson was the name of the firm at the time. But they fired the engagement team. Says, yeah, we no longer want you to be our auditors. He's like, there's no skin off our backs. I'm gonna do what's right. So yeah, he was very, very diligent in that regard. He also was a staunch advocate for something that you will come to love, or I shouldn't say love, you will come to know and absolutely hate. All right. That's continuing professional education. So has anybody heard about these things called CPE hours that you have to get? So those of you who are going to get your CPA, you're going to have to also get continuing professional education, 40 hours a year, which is a real pain to try to manage, especially when you're working in practice and you're like, how do I manage 40 hours? I don't have 40 hours in the year to sleep, So it's like trying to find those 40 hours. But it makes sense. His argument was accounting changes. We can't always be in the classroom getting our degrees. you all know what accounting looks like now, but when you're working on the real world, you won't have time to update. So that was why he said continuing professional education is so important. And as much as I make jokes about it, I agree with that. I probably don't do as diligent a job with my continuing professional education as I should. So I miss out on really important accounting changes that occur, which I've mentioned a few of those in this course. That's really embarrassing. But yeah, it's important to stay up to date with that because you got to know what's going on in the real world. Yeah, so Anderson, can we say pretty good guy, pretty good guy, a guy that we admire and respect. We wish that his type was still around operating the organizations. So moving on, question number 3. So in the video, we have Jeff Skilling, and he was characterized as a massive risk taker. So now Jeff Skilling was the CEO of Anderson for much, or not Anderson, CEO of Enron for much of the problems that were going on there. Now, just for remembering what happened in the video, Ken Slay was the original CEO, and he kind of went on to be more of the kind of the president of Enron, where he had operations taken over by Skilling. And Skilling was a guy's guy. He was one of those people that was kind of like I guess in today's day and age, this term was still used, but it was not kind of in the social vernacular. He would be a bro nowadays. Okay, so that's how we. And he expressed admiration for other guys with a bit of edge. So Luke High was one of those guys that he talked about in the video. But that was something that was very, very characteristic and emblematic of Skilling. And I'm going to go out and say this, and it's going to be on YouTube for me to say Skilling was kind of a jerk. Okay, actually, I shouldn't say kind of. He was a jerk. All right. He is one of those people that's just like if they had the term toxic masculinity in place back in 2000 or 2000, early 2000s, he would be the embodiment of that. He's kind of this trendsetter in that regard. But so we look at Jeff Skilling and we said, this is not the kind of person you want running an organization. Can he generate sales? Yes, but you can't trust a word coming out of his mouth. And there were a lot of stories that were talked about in the video about that. So let's talk a little bit about personal characteristics and lifestyle. So why should those be of a concern to external auditors? Joe, what did your group say on this one?
We said personal characteristics and lifestyle choices of managers matter because they can influence the risk of fraud and the reliability of the financial reporting. Because when the managers have personalities that favor high risk or pushing limits, they're more likely to manipulate the financial results.
Yeah. If we're talking about the manipulation, then we're basically talking about intentional misstatement of the financial statements, which we all know is fraud. We talked about that yesterday. What are the areas of the fraud triangle again? Pressure, opportunity, rationalization. We talked about that those 3 have to be present, but if we're talking about risk takers, then rationalization is probably pretty easy for somebody who's a massive risk taker. It's like, hey, if it's going to give us more money, we're willing to do it. There's very little ethical threshold there. And so certainly we look at people like that and we say, yeah, this is going to be a higher risk of fraud. And that's a natural conclusion we should come to. It seems kind of what's the word I'm looking for? Biased to do that. But I think that's something that we have to consider is that if we look at management team, we say, this is somebody who's a lifestyle. It's like a don't worry, don't care attitude, just take any risk possible. That probably translates to how they're going to operate the organization. Now, is that 100% accurate? Probably not. But is it a good rule of thumb? I would say so. All right. Second part of the question was, what areas of an assessment and audit would personal characteristics managers be most relevant? All right. This is not something we've directly talked about, but I think this is a pretty straightforward question here. So, Cole, I believe you're up next.
We were saying it could affect how auditors approach how to sample and what kind of tests to specifically use.
Right. So basically how we approach testing. So certainly from a fraud risk perspective. Also at a more general perspective, we talked about this yesterday with respect to the COSO framework. What component of the COSO framework would this be most relevant to? Got a 20% chance because there's 5 of them. Okay. Control environment. Yeah, control environment. Cole said that one, but I was throwing that as a ball for anybody who wanted to do it. Yeah, control environment, because we talk about the tone at the top, and if we see people who are aggressive in their approach, it's probably like, oh, controls are going to be a little bit lackadaisical here. There's going to be a lot of problems for management override. So we want to consider that as well. Yeah, how we approach the audit is definitely going to change if we look at the management team and say, I don't trust them. They're a little bit shady. Okay. Mark-to-market accounting. Now, we know that mark-to-market accounting still exists. Enron took our current interpretation of mark-to-market accounting and say, let's kick that up like 10 notches, okay? Is anybody familiar with the name Emeril Lagasse? So he is a celebrity chef, and he used to be really big on Food Network in the early 2000s. And his big catchphrase, let's kick it up a notch, because that was kind of his famous name. He's still a celebrity chef, but he doesn't really do TV anymore. That's kind of what I think. When you kick it up a notch, kick it up a notch, because that's what Enron was doing. They were taking mark-to-market accounting and saying, what can we wring out of this? Let's see what the furthest extent we can go to, and we'll go about like 3 steps beyond that. So it was being used for long-term contracts work. So what was the justification for this use? Now let's assume this is a legitimate justification, okay? So Tyler, I gave you a pretty rough question on this one. What did your group come up with?
So we said that the CEO of Enron claimed that this was that this represented the true economic value of their long-term contracts. So
Okay.
that's why it was justified.
All right. So now I'm going to ask you an opinion, and this is just your personal opinion. Do you think that their approach represented the true economic value of the transactions? No. I think the intention is to recognize true economic value, and I think there's a legitimate argument for that. Not the way Enron used it. Okay. Now we're gonna talk about the way Enron used it. Okay. That was not the case. But if we're talking about this for the intention, what the original intention was, I think there's an argument for that. First of all, we're still arguing on the accrual basis system, which again, the accrual basis system is what the source of all this fraud is, which is why I'm getting angry again, because I got a problem with accrual basis accounting. But the accrual basis system says, look, if we've got these huge projects, then we don't get to recognize any of it until the project is completed, or at least in theory, that's the way it should operate. And that's not really fair, because we're working on the project, we're generating expenses associated with this project as we go through. Now, keep in mind, this is before performance obligations were in the accounting vernacular. Remember revenue recognition from 417 or going back to 302, and you had those performance obligations. This is kind of before the standardized revenue recognition was in place. But mark-to-market accounting said, look, if you can actually justify a threshold that you meet, then you can actually recognize the revenue for that threshold. And so that was the idea, saying, well, you've recognized some expenses, you should get to recognize some of the revenue. Enron basically said, well, we're going to recognize all the expenses up front. We're also going to recognize all the revenue up front. All right. That was their argument. And so they were booking fictitious revenues on projects that never even came to fruition. They actually talked about in the video, there was a project that took place in India. Right. So they booked the contract. That project never occurred. They actually never did anything on the project, but they recognized all the revenues for that project immediately. So that is kind of the furthest extent of abuse. I think, again, I say that they go to the furthest extent. They went well beyond what would have been reasonable. So is mark-to-market accounting a reasonable approach? Absolutely. Okay. I don't think we can get rid of mark-to-market accounting under an accrual-based system. Maybe get rid of accrual-based accounting, but we can't get rid of mark-to-market accounting if we're going to use an accrual-based system, because that's just something that's going to be necessary. Now, let's assume that the use of mark-to-market accounting was deemed appropriate. It was absolutely not appropriate in the situation, but let's assume, just for the sake of that case, that we say that it's appropriate. When I say appropriate, the use of it was probably appropriate. The way that Enron used it was not appropriate. The extent they went to. But let's assume that Anderson says, we believe that it's appropriate to use mark-to-market accounting in this project, assuming that realistic assumptions are kept in place. What is the responsibility of the auditors, Anderson, to ensure that Enron did not abuse this practice? Okay. Coming back to Mary on this one. So it's question number 4, the second question.
We said that some of the tactics of the company employed included exporting and re-importing energy forced power plant shutdowns and using their knowledge of energy maps and grid.
So that's question 5. So this is the question about what should Anderson have done to ensure Enron did not abuse their practice of mark-to-market accounting.
Anderson should have done substantive testing, such as confirmations to ensure that contracts existed, review events and cash flows, make sure that they exist, as well as simple.
Right. So at a more general level, would we describe mark-to-market accounting in this context as being objective or subjective? Subjective, very heavily subjective. What do we feel about as auditors when we hear the word subjective? We cringe a little bit inside, okay? We cringe a little bit because that uses a lot of estimates. So there's going to be valuation methods that need to be heavily scrutinized. And so what would be some ways that we would want to do this? At the very basic level, we would need to do recalculation at our levels. We would need to make sure that we test the transactions to make sure they're legitimate. Look at cash flows, as Mary indicated. Also, if we think that the estimates are really complex and we don't have the expertise, can we employ specialists in that area? Yeah, we can employ actuaries to make sure that those estimates make sense. I would say that if Anderson and I employed an actuary, they probably would have come up with much different estimates for those transactions than Enron. But again, there may have been some auditor capture that took place here. So we'll talk a little bit about that. All right. Question number 5 in the video is claimed that Enron's actions as a utilities provider for California cost the state upwards of $30 million. Now, just for context here, all right. This was, they talked about this in the video that Ken Lay was a big fan or a big friend, a good friend with somebody who was very, very prominent in the U.S. political scene. Who was that individual that he was good friends with? Actually, I guess it was 2 individuals because it was George H.W. Bush and then the president in 2000, George W. Bush, or 2001, technically speaking. And so because of his political connections, they said, we need to deregulate the California energy market. We can actually provide better economies of scale in that area. And I hate to say this because I'm a lifelong Republican, but George W. Bush kind of went along with this and said, yeah, it's a good idea. Okay. So again, I'm not trying to be political here because I'm, like I said, lifelong Republican, but I don't think it was a good idea. So anyway, so in this case, the situation was problematic and the cost state upwards of $30 million. What were some of the tactics that were employed by the company, just for context? Cole, what did your group find for some of the tactics they employed?
They said they wanted to move electricity out of the state to increase demand and have power plants make excess or make excuses, have power plants make excuses to shut down.
Yeah. So yeah, they moved the energy out state and said, okay, well, we don't have nearly as much because there's a little supply, and you know what happens in economic models with supply or when demand exceeds supply, you have to increase the cost of it. Also, they created artificial blackouts, which is just that's like twisty mustache villain type of villainy right there. You know, if you actually watch Smartest Guys in the Room, they actually have audio transcripts of the operators talking when they were doing the blackouts, and they were having the time of their lives. These were guys who were just kind of like, I know exactly what we're doing, and I'm having so much fun doing it. We're making so much money off of doing this. It was awful, and it cost the state of California like $30 million just for those shenanigans alone. Now, do these findings suggest that unregulated markets represent more or less risk? And you notice I said choose one. The reason I included that in there is I've asked this questions like this in the past on exams and in contexts like this. And if I say there are some more or less risk, people will say yes, which technically it's the correct answer. It is definitely one of those 2. Okay. For auditors to be considered as part of their overall risk assessment. Joe, what did your group find on this one?
We said they represent significantly more risk for the auditors as there's more opportunity for manipulation and greater returns on fraudulent activity.
Yeah. So if we're talking about unregulated markets, these are basically areas that have less scrutiny. Oftentimes, there are going to be less compliance associated with that. So the clients can run a little bit more free and roughshod. They can do whatever they want. And that's definitely what Enron did in this situation. For the auditors here, that needs to be something we include in our risk assessment. Unregulated market, that is going to be a much higher inherent risk. That's going to be something we have to consider as far as our audit approach, because that's going to affect the risk and material statement in our audit. So it's something to consider as well in that regard. All right, you guys ready for the difficult part? What is a special purpose entity? Okay, so those are the easy definition. Mary, what'd your group say on what is a special purpose entity?
They're entities created by corporations, usually as subsidiaries, but sometimes as partnerships or trusts, for a single, well-defined and narrow purpose, usually the acquisition and financing of specific assets.
Yes, so a special purpose entity is basically a subsidiary, which under certain rules can actually be treated as a separate entity, but it's usually used for a very singular purpose and supposed to be something that's going to be a one-time use. Is that what Enron used them for? How many special purpose entities did Enron have? I don't have a quantity for you. We'll just say a lot. They had plenty. Okay, they had plenty of purpose entities. So what purpose did special purpose did Enron use SPEs? Mary, what did you say on that one?
The that under state liability and then overstate it.
Yes. So basically, they shifted the liabilities off to the balance sheet to their own benefit. Now, the way the special purpose entities work is an illusion. It's one of those things. There's a reason why they were called the smartest guys in the room. Is somebody came up with this accounting treatment that was completely legal under GAAP at the time, but was extremely abusive. Extremely abusive. Now, I say completely legal. There is a caveat to that. We'll get to that here in just a second. But let's talk about special purpose entities. Now, you say, how do these work, Dr. Barnes? My true answer is, I don't know. Okay. I could not tell you. I have studied this now going on 20 years, a little over 20 years, trying to make sure I understand special purpose entities. After 20 years, I have a rough idea of how they work. So let's talk about a rough idea. Now, I'm going to put up this Excel sheet, and I'm going to tell you right now, this is not just simplified. This is overly simplified. I brought it down to the very nuts and bolts. Is this the way it works in reality? Absolutely not. Okay. If you're going to say, well, I'm an expert in special purpose entities, I'm going to tell you I'm not an expert on special purpose entities. And this is something I've scrutinized now specifically for 10 years, but for a much longer period of time because it's been of interest. So let's talk about this as special purpose entities simplified. Okay. So what Enron would do is they would have an investment that they engage in. We've already talked about those contracts where they take it part. Okay. So they basically say, here's our investment for $100 million, and we're going to have a bond payable for $100 million. So the value of this investment is $100 million. The problem with these investments is they very rarely panned out. So they lost value very, very quickly. So if you're starting to lose value on your investment, what do? You take a loss, right? Or hear me out, you use a special purpose entity to artificially inflate your what you're getting off this. So let's go ahead and say they create the special purpose entity, and they had really, really obnoxious names, so like Redbird or stuff like that. And it's like I don't remember. Some of the names were just kind of like, oh, you've got to be kidding. This got to be fraudulent. Nobody would name a company like this if it wasn't fraudulent. So what they would do is they'd say, let's sell our investment to the special purpose entity. So the special purpose entity will take on this investment. So they will buy the investment for $200 million, and they will basically pay cash at $200 million. So Enron is going to recognize $200 million in cash, and they're going to get the investment off their books and recognize this gain on the sale of investment. Now, it's important to note that the cash that was here, it was not free. They actually had to take out loans for them to pay cash, but the loans were collateralized by Enron stock. All right. Now, this is problematic because Enron stock was kind of the basis, one of the bases for the opinion for the loans is that Enron stock had to maintain a certain value. So it had to maintain a certain value. Now, what happens naturally speaking when you issue more stock? You issue more stock. What happens to the existing value of stock in the market? It goes down, okay, which makes sense because if you have 1,000 shares and it's worth $10 a share, and then you issue another 1,000 shares, well, those shares that you have now become more diluted. They're worth less. And the market recognizes that and say this is no longer worth $10, it's worth like $5. So basically it created this vicious circle as they kept issuing more stock to try to maintain these loans. It's like, well, the value of the stock goes down. What's ended up happening is that the loan or the companies that had the loan say, yeah, the value of the stock had to go down. So it has gone down and we have to maintain a certain value of shares. So they'd issue more stock in order to raise the capital to get to buy the shares back. It was just this really, really weird repetitive cycle that made no sense whatsoever. It was doomed to fail just based on this model. But it was a very clever model at face value. If you just did this one time, it's really clever. Now, here's the deal, okay? You may look at this and say, this has no legitimate effects because this is all going to be consolidated, right? And everybody knows from advanced financial accounting, you consolidate subsidiaries. The whole thing about the special purpose entity is it was a unique structure where a certain percentage was held by outside investors. Enron did not have to consolidate that entity. So they moved all of this information, all these liabilities, okay, the liabilities they basically paid off the bond and that they were moving these liabilities they had off to the balance sheet, which is a bit of a misnomer, okay? They weren't actually changing liabilities to off balance sheet. They were just shifting the burden of those liabilities off the balance sheet. So that was kind of important to note. Now, we can always look at this and we can say, well, here, what's the caveat? What's the catch, Dr. Martins? The answer is 3% outside ownership. So as long as there was some entity outside of Enron who was willing to invest 3% in the special purpose entities, Enron did not have to consolidate. So they didn't have to recognize the burden of that payable that was owed to whatever or for whatever purpose. And so I guess technically speaking, the loans payable would be that burden that was shifted off because this is now being held by this special purpose entity like Red Hawk or whatever the name of the organization is, the name of the special purpose entity. It's no longer being held by Enron. Now, there's an interesting question, and we're going to talk a little bit more about this. Say the accounting standards at the time only required a 3% outside ownership of SPE construed as a separate entity from its parent. In your opinion, and I'm asking your opinion on this one, do you think that 3% represents a reasonable threshold? Okay, reasonable threshold in this one. So Cole, what do you think on this one?
We said 3% was not a reasonable threshold. We said it made it way too easy for companies to appear independent when in reality they were not. We said owning up to 97% of the corporation without it appearing to be a subsidiary was far too much.
Yes. So yeah, 3% is not going to be nearly enough. But Tyler, I realize I skipped you. I'm coming to come back. So, yeah, 3% is definitely one of those ones that we'd say is a little bit suspicious, considering consolidation is basically anything that's less than 50% of something that's included. Special purpose entity is going to be one of those ones that's just like, yeah, this doesn't make any sense. At the very least, it's going to seem shady, especially with the volume of usage that was being used. Now, the interesting thing was this was absolutely transparent. People at the time were basically applauding Enron, saying, yeah, we know what they're doing. We think it's great. Okay, we think it's great. They're moving the liabilities off balance sheet so the markets can actually explore it. That's why they increased the value. Here's an interesting fact, though. You know that 3% outside ownership? It wasn't truly outside ownership. They actually had the executives of Enron who were buying those additional 3% shares. Andrew Fastow's name is like he made a lot of money off this. He was making money off these purchases of the shares of the 30% shares of special purpose entities. Oh boy, I tell you, that's just like getting that real twisty mustache villainy type stuff. I'm telling you right now. It blows your mind right there. Okay. What was Sharon Watkins' role in the Enron scandal? Okay, go back to Tyler. What's your group say on this one?
So Watkins was the vice president for corporate development, and she sent an anonymous letter to Lay warning him about the company's accounting practices. She also contacted a friend who worked at Arthur Andersen, who then drafted a memorandum to give to the audit partners about the point she raised. Watkins met individually with Lay and gave him a 6-page letter further explaining Enron's accounting issues. And she eventually took the issue to Enron's law firm, Benson and Elkins, who reviewed the issue and concluded that there was no wrongdoing.
Yeah, so I'm telling you right now, this is time of this day and age, you would pray for somebody who's a whistleblower like this. This was somebody who was so bound and determined to do the right thing. And so Watkins basically sent an honest letter the first time. Ken Lay looked at it and says, yeah, I know that we're committing fraud. Trunk it up and put it to the trash. Then reached out to Anderson and said, yeah, you should scrutinize this a little bit more. And Anderson's going to be like saying, yeah, but we're making so much money. It's like they can commit fraud as long as we're making money. Yeah, okay, long-term consequences. Then she actually sat down with Ken Lay and says, here's the deal. I've outlined my concerns in this letter, and there's actually, you can look online. I don't remember the name of the document, but it was included in one of the reports that I followed up on Enron. And yeah, I talked about the letter. And she actually pointed out point by point all these concerns and said, yeah, I don't think Enron's going to be in business a year from now. This is a whole house of cards that's going to fall apart. Ken Lay kind of went to the other executive. And the other executive said, yeah, we probably should fire her, but we would probably face litigation if we did. So let's just ignore her. That's literally what they said. Is that like they said, fire her for being a whistleblower. Wait, let's not do that. We don't want to get sued. All right. The executives were just kind of like, yeah, she's not on board. She's basically tainted goods there. You know. So yeah, certainly somebody who went above and beyond the due diligence with respect to whistleblower. So then I had you go and look at the Sarbanes-Oxley Act. And don't you just get a little bit of a fuzzy feeling inside when I tell you to go look at the Sarbanes-Oxley Act? It's like saying, I love this stuff. This is why I became an accountant. Okay, so look at the Sarbanes-Oxley Act. So Section 806. What is Section 806? Okay. Actually, so I didn't even mention that in the question, but that was kind of one of the big ones. So let's go do the general question, then we'll talk about Section 806. Okay. So first of all, let's talk about the general term. What effective actions have been subsequent drafting the Sarbanes-Oxley Act? Joe, what's your group say?
Strengthen corporate responsibility, increase legal protections for whistleblowers.
Yes, so definitely change the rules for whistleblowers. Basically said, if you're a whistleblower in the organization, there need to be, first of all, clearly defined channels for publicly traded organizations to be able to report concerns about operations of management and malfeasance. But there was actually a section that dictated this. Can anybody guess what section it was? It's 806. Yes, 806. Section 806 of the Sarbanes-Oxley Act actually clearly defined the guidelines for whistleblowers to be able to report and establish whistleblower protection. So now people should be able to blow whistles on corporate operations without any fear of reprisal. How many people think that actually works in practice? I'd like to think that it does. The Sarbanes-Oxley Act mandates that, but I will say that people probably have gotten blackballed still under the Sarbanes-Oxley Act just because of reprisal. It's really, really unfortunate that people do the right thing and they still suffer penalties for that. But Sharon Watkins is one of those people that, yeah, I think she ended up identifying as Time Magazine's Person of the Year after the fiasco, because she did so much to try to put light on this, and everybody just kind of shoved her concerns under the rug. But yeah, big part of the Sarbanes-Oxley Act, that Section 806 area. All right. So I had you go and look at the Wikipedia page, and I said the Wikipedia page claims that Anderson earned $25 million in audit fees and $27 million in consultant fees annually represented a conflict of interest. So this is a pretty basic question. How might receiving consulting fees for other assurance work compare the work of the independent auditor? I'm kind of bouncing around all over the place here. I'm going to jump back over to Tyler again. So what did your group say on impairment of independence?
So we argued that while the audit department is relatively independent of the assurance department, they still ultimately report to the same individuals. So they're not truly independent of each other, and there's an issue there.
Right. So if we're talking about consulting fees and insurance work, there's definitely some problems with basically the upward framework. Are there other issues that we might have in this regard as well? So let's say that I'm the auditor and I want to issue an adverse opinion. Say, Enron, you're doing wrong. Okay, you're doing wrong, and we can no longer sign off on an unqualified opinion. So am I going to lose that audit client? Probably. Okay. Am I going to lose a client in other areas as well? Probably as well. How many of you would be willing to just say goodbye to $52 million if you had easy access to that? I'm going to tell you right now, I consider myself an ethical individual. It'd be very hard for me to say, oh, $52 million. Yeah, I don't really need that money. Yeah. So there was a loss, not just of the audit fees, but also the fees associated with the consulting gig. So it's like, I guess you all don't want that money. It's like, yeah. And I know it makes up like a quarter of the Houston Office of Revenue. So yeah, it's certainly be a blow to lose all that money annually. It's like, did we say adverse opinion? We definitely meant unqualified opinion. Yeah, we don't have any problems whatsoever. All right, now that's going to be the good and well. And so the Sarbanes-Oxley Act has said now that you can't provide assurance services for most assurance services if you're the auditor. And we're going to scrutinize that a little bit more in depth next week when we talk about Lehman Brothers. I think that's a good practice, but is there an externality associated with that? Probably so. Probably so. Is there a cost prohibiting external auditors from providing other assurance services? Mary, what do you think?
One cost hiring, there's a possibility to reduce quality and over knowledge.
Right. So you've got one who's an external auditor. You've got a completely separate firm that's doing consulting and assurance services, and they're having to gain similar types of information. Now, let's just think about this from a practical standpoint of the work that you all do in this course. How many of you all, when you get my questions and my assignments, say, well, we're each going to do each of these individual questions, and we're going to all do them, and then we're going to compare our answers? How many groups do that? Raise your hand. I'll call you a liar. I hear you all separate out the questions, and that's a logical approach, okay? You're separating out the work, and you're basically gaining that information. If you have to do the same work over and over again, that's just a loss of efficiency. That's a loss of efficiency. And that's basically what we're talking about here. Auditors have to gain information on the client. The consultants have to gain that information. Why not just have the auditors use their existing information? The answer is because the auditors may be captured by the client. Now, you're going to hear me use that term a lot next week. Auditor capture, that basically means they lost their independence. They're not independent from the client. And so there's a bit of a trade-off there. How do we actually say what is best from an expertise perspective without actually violating independence? The answer is we don't know. There's actually been a lot of research on this area. I've done some research in this area, and I don't have a good answer. I don't know what the point of cutoff is. Some people would say we're going to go to one extreme, and some people are going to go to another extreme, and some truth probably lies in the middle. But the answer is we probably should not prohibit auditors from providing any and all services, but they can't provide all possible consulting services because this is the outcome that we have in this situation. There's just too much independence issues. Subsequent to Enron's collapse, Anderson was found guilty of obstruction of justice, primarily due to destruction of documentation and communications with respect related to audits of Enron. By the way, this is one of those interesting ones that if you go and you look back, there's actually a Saturday Night Live episode with Tina Fey. If you go on Peacock, you can find it. It's the episode that was hosted by Jack Black. It was like April something, 2002. I meant to show it at the beginning of the class and I completely forgot about it, but we don't have time to go look at that now. Anyway, but one of the things they talk about is they talk about the shredding of documents. Now, just as a very basic question, is it reasonable to shred documents associated with an audit? Well, it depends on what the documents are. Yeah, as always, it depends. Yeah. And it depends on what the documents are. If these are client work papers that we don't want, or like our copies of client documents that we don't want to lost for proprietary purposes, absolutely. If you said, I make copies of this invoice so I can actually document my work papers, we don't want to put those in the work papers as well. We want the clients to be satisfied that they're not getting their personal information shared. But what if we're talking about the scale that Anderson was doing in this situation? It's like, yeah, we're totally guilty. Let's shred everything that shows evidence of our guilt. That's certainly a problem. By the way, I had an argument with my OU professor about this because he was saying Anderson did nothing wrong. And then I said, well, in this Business Week article, they said they were shredding information that was should have been included in the work papers. And he was stumped for a second. He was like, oh, I didn't catch that. Like, yeah. But yeah, that was the point I knew that I could outthink my professor. Okay. That's what I aspire all of you all to do is to outthink the professor, which is a much easier task for you than it was for me. So anyway, what responsibilities does an external auditor have with respect to documentation under PCOB standards? Let's go back to Joe.
They have to retain audit documentations for at least 7 years after it is issued. They're not allowed to delete or discard documentation after the documentation completion date, which is usually 45 days after the report release date.
So I do want to make a comment about that because there has actually been a change. Remember we talked about continuing professional education? I actually knew about it. I found out about a change as a part of this project. So what I told you on auditing was wrong. Okay. It was wrong. I told you all last year there was 45 days and Joe was correct on that. He actually referred to what I talked about in auditing. And you were absolutely right. The archiving the information I gave you was 45 days. This changed in late 2024. It's like, come on, Dr. Barnes, that's a year and a half ago. You should know this. I operate very slowly. All right. Forgive me. They changed it in late 2024. Now archiving takes place in 14 days. So you have 2 weeks to archive. So standard is much more accelerated. So, but all the other information is correct. Archiving now is 14 days, which you all probably will find that out studying for the CPA exam. That'll be one of those pieces of information. And then retention takes place for 7 years. So Joe's not to blame for this one. I'm entirely to blame. This is one that you can actually point at Dr. Barnes. Says he's given us bad information. This is one of those like a shame. Yeah. All right. So yeah. What about the ASB standards? Cole, what about ASB standards?
Auditors need to retain documentation for 5 years. I don't know if this date has been updated too, but I had 60 days following the report.
That's the same, actually. I did check that one too, just to make sure.
They have 60 days following the report release date to assemble the final file. Once that completion date passes, they may add to the file, but must not delete or discard any existing documentation.
So archiving within 60 days and retention for 5 years. And so a little bit less stringent standards, but we're talking about non-issuers in that situation. So retaining this information for a long period of time does bear cost. And I'm not just talking about the cost of actually trying to hold it in electronic storage or paper storage in Iron Mountain, whatever it might be. We're talking about basically opportunity costs to be associated with that. So what were the risks related to retaining confidential client information for an extended period of time? Tyler, you're going to finish this off on this question.
So we argued that if you retain them for an extended period, the scope of any potential data breach would be increased. There's a lot of privacy issues associated. So
right. Yeah. So we're talking about information that's very relevant to a client. It could be considered to be proprietary information, even though a lot of the proprietary details are deleted. Information and allusions about the client's operations are still available. You could actually see what their balance sheet information is and how that was generated. And so anybody who found that information was able to access information, which we know is certainly problematic in this day and age with information technology being compromised, as Tyler alluded to, the being a data breach. Holding that information for a client for an extended period of time increases the risk of that. So there is definitely a trade-off. We definitely want to have that information just in case something happens and we need to have that detail to be able to do follow-up. But we also do not want to carry it so long that it's going to increase the risk of proprietary details being shared out to the public. So there's one of the things we have to consider. These are the last two questions that definitely imply that there's a balancing act with the operation of the auditors. That's something that we have to be very, very wary of. Start to get to our careers. All right. CPA stuff on Friday along with our quiz at the beginning. So see you all then.